threat to the economy that you're warning about today?
Well, it's a financial stability. I think the Fed's got a tremendously challenging job ahead of us trying to engineer a soft landing, and we don't know what the trajectory of interest rate increases is going to be. But what they really need to be focused on is their regulatory and supervisory roles. They've been putting too much on monetary policy to try to, raising interest rates to contain imbalances, and not enough about fragility in the financial system. If we have a disruption, we'll have a deep recession. That's been the history. And so I think, that they should be building bank capital buffers now. They should be getting their banks to prepare while the economy is still strong and they're very profitable. Corporate debt is a particular problem now.
Why do you say that? What do you mean it's a particular problem?
So, we never really delevered after the financial crisis. So the banks delevered. It's to some extent, the capital levels are about 50% higher than they were going into the crisis, so that they were pretty low to begin with. Mortgage debt went down. A lot of that was through foreclosures. And corporate debt went up, and government debt went up, and actually non-mortgage consumer debt went up.
But cash flows from corporations also have gone up substantially. The ability to repay the interest on that corporate debt?
Well, and those ratios have been weakening, as we've seen over the past 12 months. This is a vulnerability that the Fed itself identified in its financial stability report. Governor Lael Brainerd has been speaking about it for some time. Janet Yellen has as well. There's a particular problem in the low investment grade and junk debt markets. Leverage lending has been a particular problem. Lending standards have been deteriorating for quite some time. Risk is massively underpriced. This is the same kind of dynamic we saw going into 2008. Then it was mortgage debt, but a lot of the dynamics are the same. With leverage loans, they're bundled and sold off to investors. It becomes a volume-driven business. Because of low interest rates, investors are searching for yield, leaving them to underpriced risk.
I mean, you said since 2008, Sheila, but what we keep hearing from the banks and everybody around them is that banks are in so much better of a place.
Yeah, I hear that. I'm inclined to say fake news. No, look, they're much better capitalized than they were. But bear in mind, the minimum capital ratio, the leverage ratio, which is the most effective, in my view, of capital ratios, still allows them to fund themselves with 95% coming from debt. Most of them are around 93 or 94%. So they're still highly levered. They're approaching the capital levels that we saw among the smaller banks, the community banks and regional banks prior to the crisis, which incidentally did a better job of lending both before, during, and after the crisis. So yes, they're better capitalized. That doesn't mean they're adequately capitalized. And the Fed has a tool. I'm hoping Mr. Powell will talk about it in his remarks later today, something called the countercyclical capital buffer that's designed to deal with a situation just like this when the economy is still strong, bank balance sheets are strong, they're still earning money, to raise those capital buffers because we're very late in a business cycle. There will inevitably be a downturn. There's probably going to be trouble in the corporate debt market when that slowdown occurs.
You think so? I mean, refinancings have a ways to go yet. Certainly when you look at high yield, which you just said you believe risk is massively underpriced in, you're not going to see a wave of refinancings where the corporations need it until a couple of years from now.
Well, I hope that's true. And the tax cut helped. They did. A lot of that was used to pay down debt. That was helpful. But if you look at the overall numbers historically, you're still seeing especially junk debt and low investment grade at highs that are very elevated by historical standards. And yeah, I think if you have a big default, right? There are a couple of iconic names that are they're still investment grade, but they're low investment grade. You have a bankruptcy. We don't know what that will trigger. My sense is the investors are skittish already. The debt market's pretty much dried up in December.
Well, high yield dried up. But I'm curious, obviously the risk was spread far and wide with the securitization of mortgage products. Do you feel as though that is still the case here?
It's a good question because I think let's just say this turns to be very bad. One thing that will help, that a problem we had with the mortgage debt market is that there are lots of smaller loans with retail investors, right? At least you will have two sophisticated sides in this kind of a situation, dealing with the need to restructure the debt, to rehabilitate the company, to forgo some payments or whatever, reduce principal. Those are the kinds of tools that we tried to use, but it's very difficult to use because we had these millions of mortgages, we had investors scattered hither and yon. It's very difficult to get the two sides together to get these loans restructured in a way that would have done a lot more to help. So that is one.
But if the Fed
helper.
pauses and signals more flexibility on the balance sheet, doesn't all of this just get kicked down the road even?
Well, I hope
later?
not. I mean, that's the whole idea of a countercyclical capital buffer. Regulation is typically pro-cyclical, right? So when times are good, you loosen up on regulation, everybody's happy, losses are low, the risk-based capital requirements go down, and then when things turn south, you tighten regulation at just the wrong time. The countercyclical buffer, the idea is, tighten regulation, tighten capital standards a bit when things are good, and then when the downturn comes, you can eliminate those buffers and let banks expand their balance sheet and capacity to support the real economy.